Hello and welcome to the Capital Wire. In this video, we will learn about what causes stock prices to move up and down. Most people understand the basic idea of investing, buying low and selling high. People buy stocks at a low price with the hope of selling them at a higher price in order to earn a profit in the future. But what actually causes stock prices to move up and down? In this video, we're going to be taking a look into some of the factors that cause a stock's price to move up and down. Before we get started, it's important to understand that an individual stock has three different components associated with its price. This includes the bid, the ask, and the current market price. The bid price is the highest price that a buyer is willing to pay for a single share of stock. The ask price is the lowest price that a seller is willing to accept for a single share of stock. And the current market price is simply the last price a share of stock is sold for. The difference between the bid price and the ask price is referred to as the spread. Typically, the lower the spread of a stock, the more liquid the stock is. Now, let's dive right in and see some of the reasons why stock prices move. One of the most fundamental reasons why stock prices move is due to supply and demand. This is basic economics 101. If there's a larger supply of a stock than there is actual demand, the price of the stock will likely go down. If there's greater demand for the stock and a low supply, the price of a stock will tend to go up. Another reason the stock prices move is due to information related to the stock. A stock represents a publicly traded company, and any news or information directly related to the future performance of the company can have a direct impact on its stock price. This can include earnings reports, press releases, new products being put out by the company, court filings, mergers and acquisitions, change in company management, stock ratings and upgrades, lawsuits, and so much more. Informational factors can cause the price of a stock to move quite aggressively in either direction, depending on how sensitive or important that information is to the future of the company. An often overlooked factor and quite unknown to most common investors, which can have an impact on the price of a stock, is low supply of shares. If a stock has a low amount of public shares available for purchase, this can cause the stock price to experience higher amounts of volatility due to the fact that a small amount of buying and selling can influence the price. Another important externality which can influence the price of a stock is economic factors. This can include interest rates, unemployment data, inflation. These are external conditions which can alter the demand and supply for a company's stock. Inflation is a big driver and it can influence the price of stocks. Historically, low levels of inflation tend to push stock prices higher, while high levels of inflation tend to push stock prices down. Interest rates can also have a dramatic impact on the price of stocks. Low interest rates allow people to borrow money at lower rates, which increases their purchasing power that tends to drive stock prices higher. Higher interest rates reduce people's purchasing power and can cause stock prices to go down. Higher than expected levels of unemployment can cause the overall stock market and prices to go down. While low levels of unemployment signal strong economic stability, it can cause stock prices to go up. And last but not least, the occasional Elon Musk tweet. Elon Musk has a lot of power behind his tweets and can influence investors' sentiment to either buy or sell shares of companies he owns or products and services he believes in. If you enjoyed this video, please make sure to hit that subscribe button so you don't miss future videos about stocks, personal finance, and investing. Also, let us know in the comments what you think the most important factor is that moves stock prices up and down.